Okay, let's see. Let's talk about dividends for a minute here. Okay. So again, you know, we learned in college accounting that a dividend, of course, is just a share of the profit that we pay out to stockholders. Basically, the only difference here is how we handle the accounting side of it. So what'll happen is there's actually 3 dates dealing with dividends. So the first date we deal with is what we call the date of declaration. So basically, the board of directors is going to approve a dividend. And when they do that, they're going to have a date of declaration. So the first date is just saying board of directors declares a cash dividend and it authorizes that cash dividend. So that's the date that they approve it and say, hey, we're going to pay a dividend. Excuse me. They might, if it's a stock dividend, so instead of, you know, maybe our cash reserves are low because we are putting money into new operations or something, we can declare a stock dividend instead and increase their stock amount for each shareholder. Again, that would have to be approved through the board of directors, but they would do that on the date of declaration. They would have a date of declaration, whether it's cash or stock dividend. Okay. In both cases, though, we're reducing our retained earnings. Okay, retained earnings is, of course, you know, if you remember back from college accounting, you had beginning retained earnings, you added in net income, you subtracted out dividends. Okay, so dividends, whether they're stock dividends or cash dividends, are reducing our retained earnings or the profit that we're keeping in the business. So that first date, that date of declaration, the board will decide to do a cash dividend. You know, the board of directors will make that, or the CEO usually, and like the CFO will make that recommendation. The board of directors will decide on that. Basically, we have to have sufficient retained earnings. We can't go negative in our retained earnings. So we have to have enough in our retained earnings to declare a dividend. Retained earnings is going to be, you know, again, that could be from several years built up though, okay, profits that we've built up. And then we're going to need sufficient cash. If we're declaring a cash dividend, well, that makes sense, right? We have to have the cash in order to do so. And usually that's going to be in excess of some type of reserve. The company might say, oh, you need to keep at least 100,000 or 50,000 in cash. So we would look at that too. And then the board has to vote on it and say, yes, we approve this dividend, okay? So with a cash dividend, we have to have sufficient retained earnings, sufficient cash, and the board has to approve it. Okay. The one thing to remember when we're dealing with cash and retained earnings, we could have a lot of cash and have a low retained earnings balance, or vice versa. It sounds odd, right? You would think, oh, if we have a lot of retained earnings, we'd have a lot of cash. We could have a high retained earnings balance, you know, we'd made a high profit, but again, maybe we had used cash to buy new equipment or buy land or invest in other stock options, you know, in other companies. There's ways in which we could have low stock and high, or low cash and high retained earnings. And the reverse could also be true. We could have a low amount in retained earnings. We would not have been profitable, but maybe we just borrowed a lot of money or issued a lot of bonds. So we have this huge amount of cash, but we don't have any retained earnings. So that's why they look at both accounts. That's why it's important, because we don't want to issue dividends if our cash is because of like bond money or like a loan. You know, that's not true. That's not profit, okay? And the reverse is true with, we don't want to take out a retained earnings if it's not sufficient. So that's why we look at both balances. Okay. So again, when we declare that a bond will, or bonds, sorry, when we declare, I need coffee too apparently, even though I already had some. When we declare dividends, there's the date of declaration, the board has approved it, and they say, we are declaring a $5 cash dividend on every stock or whatever. You have the date of record. The date of record, there's going to be no journal entry. It's just saying, as of this date, all the stockholders on record will receive a dividend. So they declare it up front. They could declare it, say today, October 22nd, that as of, you know, November 1st, any stockholders on record November 1st will get this dividend. and then we'll pay it out on like November 15th. Okay. So the date of payment is when we actually send out the cash. So on the date of declaration, we're going to record the liability because we're saying we are going to pay this dividend. Okay, so the date of declaration, we record the liability. The date of record is just record keeping purposes only. There's no journal entry. So that's just when we look at all the people that are stockholders. All of those people will receive a dividend. Okay. We declare this up front, which is kind of nice, right? Because if I was thinking of selling my stock and then I'm like, oh, wait, I'll wait 2 weeks and get my dividend first. So they always declare it in advance for not just that reason, but for record keeping purposes. Okay. And anyone that purchases stock before that date will also get it. And then the date of payment, we're just paying off that liability. Okay, so it'd be debiting the liability and crediting cash showing we've paid that dividend. Okay, so to illustrate, assume that on October 1st, Hibber Corporation declares the following cash dividends with a date of record of November 10th and a date of payment of December 2nd. So October 1 is the date of declaration. That's the date we're going to incur a liability. And they're showing us the total dividends that we're paying out because we are declared on our preferred stockholders a $2.50 dividend per share. Well, there's 5,000 shares at $2.50, so we're paying $12,500 to preferred stockholders, and then a 30-cent dividend per share to common stock. So 100,000 shares times 30 cents, 30,000. So all total, we're paying a cash dividend of $42,500. So that date of declaration is October 1st, date of record is November 10th, date of payment is December 2nd. So on the date, the declaration date, we debit cash dividends, $42,500. It's just your normal dividend account. Okay, we just say cash dividends because we could have a stock dividend. And then we're going to credit cash dividends payable. So that's just a liability account. We haven't paid it yet. Okay, so that's when we declare it. Again, the date of record, November 10th, there's nothing to journalize. And then our last date, when we actually pay it, pretty simple. We debit cash dividends payable because we're paying off that liability, and we credit cash. Okay. So you just have to know the 3 different dates. The date of record is there's never any journal entry. Okay. Any questions on that? All right, well, let's switch over to the practice and we'll do one together so you can kind of see what it looks like. Okay, so number 2 on the practice. It says the declaration, record, and payment dates in connection with the cash dividend of $335,000 on a corporation's common stock are October 1, November 7th, and December 15th. So again, October 1 is our date of declaration. Our date of record is November 7th. And then our date of payment is December 15th. So this one, they didn't even have us calculate the actual cash dividend. They just told us we're paying $335,000 cash dividend. So what is my journal entry on October 1st? Very good. We debit cash dividends, which again is just your normal dividends account, increases on the debit side. Remember, it's reducing retained earnings though overall. And then we credit cash dividends payable. And again, they made this one really easy. Just the total cash dividend of $335,000. November 7th is our date of record. So what's my journal entry? Nothing. Very good. There is no journal entry on November 7th. So November 7th is the date of record. That's just when we check our records to see who the stockholders are, so we know who we're paying. December 15th is our date of payment. So what do I debit and credit there?
Cash dividends, cash.
Yeah, cash dividends payable. Make sure you do the payable account. And then we credit cash. So cash dividends payable gets debited because we're paying off that liability, and cash gets credited. And the only difference from college accounting procedures is that we're creating a liability of it before we pay it. Okay, so we're declaring it. This is true, more aligned with true practice with dividends. We always declare them in advance and then pay them later. Okay. Any questions on that one?